Hi guys! So in today's video, we are going to talk about knowing your options, the difference between OTM versus...
ATM. This is not the money drawing machine, so I will explain what this is.
Okay, before that, let us introduce ourselves.
Okay, hi, I'm Joel.
And I'm Sarah.
We are husband and wife team, and for me, I'm Mr. Fundamental Analysis, and she is.
Miss Technical Analysis. Okay, so I compliment Joe, okay, by reading the market trends so that we can enter and exit our time.
Yes, and my ultimate aim is to collect good businesses at a very sensible price.
And we believe that together we are better.
Yes, and that includes you.
Okay, so if you would like to get connected with us, you can connected with us through Facebook or YouTube. Okay, so the reason why we decided to do this video was because we had many people asking us how do they choose an option contract. Do they choose out of the money or at the money? So we are taking time to do this video so that it can help to address this frequently asked question.
Yes, so before I carry on, maybe I will just go through some option basics. Alright, so what is an option contract? It is actually a contract that allows you, the owner, to buy or sell shares at an agreed price. This is what we call the strike price within a period of time. So this is unlike your marriage contract. That one, the period of time is forever, hopefully.
Okay, so you're with me forever, okay, Joe?
You also. So okay, there are two types of options. One is a call option, the other one is a put option. So from this table, you can see what happens to the buyers of the call option or a put option, and what happens to a seller of a call option and a put option.
Okay, for today, we are actually going to focus more on the buyer's point of view, right?
Yeah.
Today, buying calls and buying puts.
Yes,
Yeah.
correct. So we will leave the seller's perspective to another video.
Yeah.
All right. So this chart, you can take a photo of it if you want to. All right, this is a very good pictorial summary of what you expect the share price to behave when you do a buy call or a buy put. So for a buy call, you expect the price to rise. All right, and for a buy put, you expect the price to fall. Okay, because only if, when the buy put price, the share price of the buy put, okay, underlying buy put falls, you will profit. Okay, so the big question now, how do you select your buy price? How do you select your strike price? Okay, there are a few ways we do it. Of course, we never forget our fundamental analysis valuations. All right. Okay, and like she is Miss Technical Analysis, so she will never ever forget looking at the charts, okay, to triangulate on the strike price. Okay, so it leaves the third question. Okay, once you know the strike price, do you do a at the money contract or a out of the money contract? Okay, so I can see a lot of you, you are very blur, you don't know what out of the money, at the money. Okay, simply put, an at the money contract is where the current share price is. For example, if a current share price is trading at $100 and you decide to buy a contract, whether be it a call or a put at $100 strike price, you are doing it at the money. Okay, so then what is out of the money? Out of the money is actually when for a buy call, you decide to go higher. All right, the higher you go, the more out of the money you are. So there is no one out of the money strike price. Okay, it extends to the whole range, from infinite to maybe $100.
Okay, so why is this called out of the money? Because if you recall, buy call gives you the right to purchase, okay, the shares at the agreed strike price. So currently, because the price of the share currently is $100, okay, but you are agreeing to buy, okay, the shares at higher than market price. So this is what we call out of the money.
Yeah.
Okay, so because you are agreeing to buy at a price higher than the market, this therefore is considered to be out of the money. And the higher the strike price, okay, the more out of the money it will be for buy call.
Okay, so the opposite is true for a buy put. Okay, the lower you go below the strike price, the more out of the money you are. Okay.
Okay, so why is this the case? If you recall, a buy put gives you the right to sell the shares at okay, the agreed strike price. So for example, the current shares is $100. Okay, so if you actually go and buy a put, okay, that is below, okay, the current strike price, what you are doing is you are agreeing to sell your shares at a price lower than the market. Okay, so that's why this is considered to be out of the money.
So typically out of the money will also mean that you are taking on an inherent disadvantage.
Yeah, so you're actually taking on greater risk. Now, because you take on a greater risk for out of the money contracts, you actually pay less upfront premium. Okay, so this is the reason why you pay less premium.
Okay, for those who are not familiar with contracts, premium refers to the sum of money you pay to purchase that particular option contract.
Okay.
Okay,
Yeah.
so like what we said just now, okay, no, for the buy call out of the money, nobody actually in the right mind will actually want to buy the share at a higher price, for example $110 or $105, when the market allows you to buy it at $100. So therefore you pay a lower premium. Okay, the opposite is true for buy put. Nobody in the right frame of mind will actually want to sell at a lower price in the market. Okay, so therefore you pay a lower premium if you take on this contract. Okay, so the main difference between an ATM and OTM option is actually this thing called option delta.
Okay, so just to because we have actually been trying to talk about out of the money, right? Okay, so what is at the money contract? So at the money would be, for example, if you buy call at the current strike price, which is $100, or if you buy a put at the current strike price, which is $100. So that is at the money. Okay, so generally at the money, contracts would actually cost more premium as compared to out of the money options. Okay, which is the reason why some people with lower capital would actually choose to buy out of the money contracts, and they take on the inherent risk in this sense.
So now, okay, so what is option delta? Okay, from Investopedia, I pull out this website. Okay, an option delta means actually if the underlying stock price increases by $1, let's say, okay, the option that you have, okay, based on the delta, you will raise or fall accordingly. All right, for example, if your particular option that has a delta of 0.65, all right, if the share move up by $1, your option, okay, will actually increase. Okay, if you are doing a buy call, your option price, the price of that contract, will actually increase by 65 cents per share. All right. Okay, so this is a snapshot from one of our trading platforms. So you can see, okay, on the right hand side are all the put contracts.
Okay, so these are the put contracts over here.
Okay. Oh, this is for S&P 500, okay, the ETF, ticker symbol SPY. So we can see that the last traded price is 253. So I would say 253, okay, is at the money. All right.
Or in the sense, 253 is actually the current price that the market is selling the shares at, or the current price that you can buy the shares at.
Yeah.
Okay. So generally, you can use this highlighted portion. Okay, refers to actually, in the money. So 253 over here would actually be at the money. So over here we will just indicate at the money. Okay. Okay. So then, if it actually, so if we are looking at buying puts, right? If you are looking at buying puts, then generally, okay, so as you go upwards over here, it would actually be more and more out of the money.
Yeah.
Yeah.
So Sarah mentioned in the money just now, ITM. So what is ITM? Okay, ITM is actually the opposite of OTM. It means that you are buying a contract that you have inherent advantage. Okay.
Yeah.
But the shortfall, the shortcoming of it is you definitely need to pay more premium.
Yeah. Okay. So how about for the call?
Okay. So as you can see, let's say if we say that at the money is 253, can you see that in this column, the rightmost column, it shows the delta.
Okay.
So as we go, the more out of the money we go, okay, the delta actually decreases. So that means let's say if I were to do a buy put at strike price 243, okay, if SPY drops by $1, my buy put at strike price of 243 will only increase by 35 cents.
Yeah. Okay. So can I ask Joe, if you want to buy a put, right, do we go to the bid or the ask?
Okay, it's at the ask.
Okay, so this is actually buying put lah.
Yeah.
Okay, so we can see, right, okay, at the money, right, okay, the contract is actually worth $1,094, right?
Okay.
Because each contract actually represents 100 shares.
Yeah.
Okay. For this, the delta is actually higher because for every $1 drop in the share price, my contract actually gains a value of 49 cents. Okay. Okay, but however, if I choose the out of the money contract, right, which is somewhere around here, okay, I'll only have to pay. I pay actually a huge discount. I only pay 730 cents. Okay, but the inherent risk that I take is that I need a bigger movement in the share price because for every $1 drop in the share price, I only gain 35 cents for the contract.
Yeah.
Yeah. Okay, are we going to be talking about calls or?
Yes.
Okay.
We will also talk about calls.
Okay, let's talk about calls.
Okay. Okay, so you can see, okay, on the left hand side, okay, is all the calls contract again. 253 is the ATM, okay, and as you can see from now, okay, the delta is at this column. I've already given you a red arrow. As you can see, the further down, the higher strike price you go, okay, the delta actually decreases. This is exactly the same working principle as a buy put, just that because one gains value when the share price goes up, and the other one gains value when the share price goes down. So that's why they have opposite directions.
Yeah.
Okay, so how do you see a delta? How do you? Okay, maybe we go to our trading platform.
Okay, our trading platform, which is this one.
Yeah. So
Okay.
how do you add this column in?
Okay, so we
Okay.
go to trade.
So you go to an option chain. Just select any option chain.
Okay, so let's say I want to buy SPY.
Okay.
Over here.
Just click on any option chain.
Okay, so let's say we buy something that is after earnings season, for example.
Yeah.
Okay, let's choose maybe 18 September 2020.
Okay.
Okay.
So as you can see, on my computer now, I cannot see delta. So how do I pull this information out?
Okay.
I go to the layout.
Layout.
Okay, click on it.
Okay.
Okay, go to customize.
Customize.
Okay, on the left column,
Okay, over here.
okay, you just type delta. You see, can you see delta coming up? Click
Okay.
on it.
Alright.
Okay, then just click on add item.
Okay, I mean to avoid confusion, let me just remove these two other items.
Yeah,
Okay, so ta-da! You would see
you will see delta.
delta appearing over
Yeah.
here at the put position and at the call position as well.
Yeah, so this is how you actually pull out the delta information on your trading platform.
Okay, let me just change this to single because we are actually seeing too many strike prices. Yeah, okay. So that's how you can add the delta.
Yeah.
Okay, so back to our presentation.
Okay, so I hope I've shown you how to see the delta. So right now you may be confused. You know, this is like a wrestling match. You have one big, humongous monster on your left. You know, the ATM option, and you have a few OTM options. Okay, so what do you choose? All right. So it's very simple. Before we go on to tell you how to choose, we would like to share with you the inherent advantages and disadvantages of ATMs and OTMs.
Hey Joe, why is it that one ATM is equals to 3 OTMs in this
Because
picture?
ATM you pay more premium.
Oh, so actually for one ATM I could have gotten more OTM contracts.
Yes, in fact, yes, I've already shown you one advantage of an OTM.
I see, okay.
Yeah. So, okay, this is a summary of the pros and cons of both ATM and OTMs. Okay, of course, for the ATM, it is usually less confusing for most investors because you just choose the current share price. Okay, delta is higher, like what I've shown you just now, and because the delta is higher, it needs less movement in your share price to actually make you a profit. All right, of course, for the cons, you pay more premium. Therefore, if let's say things really work against you, your max loss is higher. All right. So for OTM, the advantages is you pay lower premium. Therefore, even if the price move against you, your max loss is lower. So and because you pay less premium upfront, if let's say the share price really moves very well in your favor, the potential ROI can be massive. So it is very good. Okay, if you do it in a very volatile market. Okay, but of course the cons is lower delta. It really needs to move a lot, and if it doesn't move a lot, you will actually not make a lot of profit.
Okay, so in the other sense, right? Okay, so when do you decide whether to take ATM or OTM? Okay, it really depends on how much you think the share price will move.
Yeah.
So for example, if you think, okay, that the share price is not going to move very much, then it's actually better for you to get the ATM contract. Okay, if you think that the share price will be moving a lot, okay, then it's better for you to get the OTM contract.
For those who don't know whether the share price will move a lot or very little, I will try to be safe in the sense that I will go for ATM.
Okay, yeah.
Okay?
Or if you don't know how to do it, then don't do it at all.
Yeah.
Just save the money.
Yeah.
Yeah. Okay, so one other thing that we would like to share with you, which is very powerful, is the use of risk graphs. Okay, so you can actually execute this, right, actually using the Think or Swim platform. Okay, so to avoid confusion, I will just show less strikes over here. Okay, carrying on with our discussion just now, right? Okay, for the purpose of demonstration, I would only be looking at the put contracts because currently now is the bear market and therefore many people are buying put contracts. Okay, so let's just recap. For an ATM contract, let's say I want to buy a ATM put, Joe. Okay, so
Okay.
which strike price do I choose?
I will choose 253 or 254.
253 or 254. Okay, so both the deltas are the same. Okay, so for some of you who are more well versed in options, you would know that another determining factor that we look at will be the open interest because we want to make sure.
Add item.
Okay, we want to make sure that by the time we want to close the contract, there will be sufficient demand for us to close it. Okay, so let's see. Okay, between 253 and 254. Okay, 253 actually has a higher open interest. So let's go for 253 for at the money contract. Okay.
Okay.
So to buy, I click on the ask column and okay. So this is actually going to be what I buy. Okay. So okay, for me to actually look at the risk graph, I actually need to go into the analyze tab. Okay, so okay, let me just add simulated trade. Okay, so we agreed to actually add the 253. Okay, so let me just add that. Okay, so I have this over here already. Okay, I want to compare the ATM contract to the OTM contract, right?
Okay.
Okay, so let's take a look at maybe let's choose an OTM contract. Okay. Okay, Joe, so which OTM contract would you choose?
Let's go all the way up.
All the way up for comparison's sake, huh?
Yeah.
All the way up.
Okay. As much as we can.
Okay, maybe we can choose this. I mean, it has quite a good open interest, like $10,000.
Or maybe we go even higher.
Okay,
235.
All right. Okay, so this one, 235. Okay, so let's say I buy this one. Okay, you can see that the delta is a lot lower. Okay, it is actually only 35, whereas for the ATM contract, okay, the delta was 47. Okay, so what I have here now, I have two contracts here. Okay, one is ATM, the one at 253, and you can see that I'm paying a lot more premium. I'm paying $2,416. Okay, the other one is OTM, which is at a strike price of 235, and I'm paying a lot less. I'm paying like almost $700 less. Yeah, for this OTM contract. So right now, what we want to see is we want to look at the risk profile of both of these contracts. Okay. So I have selected both contracts that expires on 17th of July 2020. Okay, so let's take a look at the risk profile. Let's take a look at one at a time. Okay, so okay, you can see that for ATM contract, the one over here, okay, just ignore the pink color line for now. Okay, so what the blue color line represents is the value of the contract on the day of expiry. So this tells you what is the value when you close it on the day of expiry. Okay, so if we look at the ATM contract, which actually we see the graph over here, let's take a look at the blue line. Okay, so at if let's say the price stays at 235, for example, over here, okay, if the price stays at around 235 on the day of expiry, my maximum loss is going to be 1772. Okay, and that is also because that is the premium that I paid. Okay, what I want to actually highlight to all of you is this red color line here, because this is actually your break-even point. Okay, this will be the point where you would actually break even, meaning that you would have no profit and no loss. So let's just bear in mind over here that in order to have no profit and no loss, right? Okay, SPY, okay, for the out of the money contract has to drop all the way to 217.12. Okay, so this is actually quite a lot. Okay, so let's just I mean, for demonstration purposes, let's just record this down so that we can actually okay, keep track of this. Okay, so let me just do a comparison. Okay, so we actually have the OTM, which we chose a 235 strike, right? Okay, in order to break even, Just now, what was the price? Do you remember, Joe?
217.
217.28. You want to break even, SPY, okay, must go down to 217, okay, point something,
28.
right? 28, okay. 28, okay, by expiry. Okay, so for example, the expiry was 17 July 2020 in this case.
September.
Actually, I realized that I chose the July contract.
Oh,
Yeah.
okay.
Okay. So then, now let's take a so beyond so if SPY were to go down beyond 217, then I will start making profits, as you can see over here. Okay, I'll start making profits, and the profits will be unlimited as long as SPY goes down beyond that. Okay, now let's take a look at the ATM contract. Okay, this part will be quite cool. Okay, so let me unselect the OTM contract and I select the ATM contract. Now you can see something very significant happen here. Now you see, right, the red line over here, the break-even price has actually shifted to a lot less. Okay, so instead of having to fall to 217, SPY only has to drop until 228 before I start to break even. Okay, so let's just record that down. So for an ATM contract, in this case, what was my strike price again? 253, right? Okay, my break even. Okay, for my break even, SPY must go down, okay, to how much? 228. Okay, 228.88. Okay, and for both of these cases, the current price of SPY is actually current price of SPY, okay, is actually 253. Okay, and in order for me to earn for both cases, okay, SPY actually has to drop. Okay, and this is actually both assuming if I close it on the expiry date. Now if you just compare it like this, you can already know that for the OTM, right, okay, SPY actually has to go down a lot more because of its lower delta in order for me to earn a profit. Okay, and over here it just has to go down to 228. Okay, and where is my profit zone? My profit zone will be when if SPY goes down below 217.28. Okay, and over here my profit zone would actually be if SPY goes down below 228.88. Okay, so bear in mind that we are all talking about closing the contract on the expiry date. Of course, if you close the contract earlier than the expiry date, okay, so just let me show you. Okay, so this calendar here, so let's say if I close earlier than the expiry date, okay, you can see that the break even price actually gets, okay, it's actually easier to hit the break even price. So let's say for example, if I were to close my ATM contract, for example, okay, on okay, what is this, on the 25th of May, for example, if I close it 1 month earlier, okay, then my break even price is shifted even earlier to, for example, $238. So as long as SPY goes down to $238 by 25th May, I would have actually broke even if I close. Okay, so anything else to add, Joe?
How about for the OTM?
Okay, for the OTM it's also the same case. So previously for the OTM, my break even price was actually 217.28. Okay, but if I close it earlier, if I choose to close it earlier, okay, then SPY has to just go down until 233, and then I would have actually started to break even. Okay, so in summary, right, we just want to share with you that actually there is no right or wrong in terms of OTM or ATM. Okay, but the very key difference is we want you to take away this concept over here, that before you choose ATM and OTM, okay, make sure that you have your thesis ready. How far do you think the share price is going to drop, and do a comparison between the ATM and OTM contract. Okay, which of these contracts allows you to be in the profit zone? Okay, then you take an action from there, right? Okay, anything else to add, Joe?
No.
Okay, right. Okay, so that's all that we have for you for today's very short video. If you have any questions on the risk graph or ATM or OTM, okay, feel free to contact us. Okay, let me just put it up here once again. Okay, feel free to actually contact us, okay, on our Facebook. Yeah, and we'll be happy to answer whatever questions you have. Okay, so please invest safe in this bear market, and do make sure that you actually choose your options carefully if you choose to invest in them. Okay, so till next time, we hope that you had a lot of value from this video, and till next time, we will see you. Okay, bye bye.
Bye bye.